A few weeks ago, Dave Portnoy of Barstool Sports made headlines for backing the new BUZZ ETF. This ETF uses artificial intelligence to track social media signals, then invests into the most talked about stocks. I think that this is a really fascinating idea, especially considering the social media frenzy that recently surrounded stocks like GameStop and AMC. And while Dave Portnoy is definitely an appropriate figurehead for the fund, I think his involvement might distract from how this fund actually works and how it could potentially perform. So in this video, we're diving into the details of the BUZZ ETF, which is the Van Eck Vector's Social Sentiment ETF. Ultimately, I want to determine whether this fund will work and if it has the potential to outperform the market over the long term. To do this, we're going to analyze the methodology behind BUZZ to understand how the stocks are selected. Then we're going to take a look at some studies and data to determine if this methodology could be an effective long-term investment strategy. After that, we'll be discussing some of the things you need to consider before deciding to invest in this ETF. And last, I'll share some of my final thoughts on this fund and what it means for similar strategies. Let's get started. The BUZZ ETF tracks an index called the BUZZ Next Gen AI US Sentiment Leaders Index. This makes the fund passively managed, because it will just invest into the stocks as they are represented in this index. In other words, there are no individuals responsible for choosing stocks. All investments are driven by the underlying index and its methodology. And this means we have to understand the underlying index, which starts with US large cap stocks. In this case, this includes any US stocks with a market capitalization larger than $5 billion. They must also have an average daily trading volume of at least $1 million for at least 3 months. After limiting the pool of potential stocks to these US large caps, the methodology uses 3 steps for choosing which stocks to invest in. The first of these steps is to collect data on how often these stocks are mentioned across various social media sites. Of course, some of the biggest sources they use include Twitter, StockTwits, and Reddit. But this also includes blogs and related sites, with plenty of well-known sources on that list. So right off the bat, I like that they include a variety of sources, because I know that some social media sites have a good amount of artificial or bot activity. The next step is analyzing investor sentiment on all of the stocks that are mentioned. For this, they use what's called natural language processing technology. This is just a fancy artificial intelligence system that comprehends context each time a stock is mentioned. By analyzing the language around a given stock, they can determine whether investors as a whole are feeling positive, negative, or neutral around a stock. This is another element that I like about the methodology, because I was initially worried that they purely looked at stock mentions. My fear was that stocks receiving a lot of negative attention would be added to the fund just because people are talking about them. But obviously, if they're being talked about for a bad reason, it's probably not a stock you would want to be investing in. The third step is ranking these stocks based on the previous data. After considering the positivity or negativity surrounding these stocks, they'll sort them from the most positive sentiment to the most negative sentiment. This also includes the breadth of their mentions, so stocks that are mentioned on many different platforms will be ranked higher than those that might only be popular on a few platforms. Finally, the 75 stocks with the most positive sentiment will be included in the index, and thereby the BUZZ ETF portfolio. For their inclusion, each stock will be weighted according to the rank on the list. So the stock with the absolute most positive sentiment will have the biggest position in the fund, and the stock with the 75th most positive sentiment will be the smallest position. The top holding is capped at 3% and gradually declines to about 0.5% for the smallest holding. This analysis and ranking is repeated every month, and the fund's holdings are updated to match. So now that we have a better understanding of how the stocks are chosen for the fund, we have to figure out if this is a winning approach to investing. Ultimately, I think we have to figure out the connection between price movement and social media activity or investor sentiment. The argument made with the BUZZ methodology is that sentiment influences price discovery within stocks, and can therefore identify successful investments before other types of analysis. The white paper for the BUZZ ETF conveniently lists 25 known studies on the correlation between social media buzz and stock price movement. And yes, I went through every single one of these. A lot of these studies were pretty similar, so I'm going to summarize some of their findings and what they tell us about using social media to pick stocks. First of all, a handful of these studies analyzed general mood on social media and its relationship to the overall market. They didn't seek out mentions of any stocks or indexes, they just analyzed the mood of users as a whole. All of these studies found that overall mood did in fact correlate to market price action, but the BUZZ ETF uses a different analysis strategy. So while these studies don't verify the BUZZ ETF strategy, they do show that social media analysis can be effective in predicting market movement. Most of these studies are focused on the idea of using social media to crowdsource sentiment and whether that crowdsourced information can be useful. In all studies, they found that crowdsourced information was at the very least important to consider alongside other forms of analysis. One source even found that crowdsourced information was more accurate than Wall Street estimates. This shows that social media sentiment analysis is definitely worth considering, but we still want to know whether it will actually drive returns when used as the primary investment decision. And surprisingly, a few studies did prove that. A study on Yahoo Finance found that trading based on online sentiment beat a buy and hold strategy over the same period. Another study in China also found that trading on sentiment produced better risk-adjusted returns than a buy and hold strategy. Finally, this study found that social media sentiment could be successfully used to predict price movements and could lead to a profitable strategy. So far, these ideas are pretty exciting because it shows that the crowd, which in the context of the BUZZ ETF is almost everybody online, will provide accurate insight into the future returns of a stock or index. It also shows that trading based on the overall sentiment of this crowd can actually be profitable and may even beat other investment strategies. But some of these studies also reveal a potential weakness of the BUZZ ETF methodology in regards to the timing of their investments. For example, this study found that Twitter sentiment was accurate, but only in predicting either positive next day returns or negative returns over 2 or 3 days. Another study found that sentiment was accurate in predicting price movements, but only analyzed the benefits for intraday trading. The next study found that trading on sentiment would produce a small 1 to 2% higher returns than other strategies with accuracy for up to 10 days. Another study found that Twitter could successfully predict next day returns. What I'm getting at here is that all of these studies focused on very narrow timeframes with analyzing social media sentiment and executing a trade. These studies prove that if you are able to collect this data and make daily trades based on the findings, you can probably achieve higher returns. However, this is not how the BUZZ ETF will work. This is because the BUZZ ETF rebalances and reconstitutes its fund on a monthly basis. So while these studies show that many of the ideas behind the BUZZ ETF are valid for making investment decisions, nothing has proven that these ideas can be effective for periods longer than a few days. So unfortunately, we don't have much data to go off of in order to assess whether BUZZ will be an effective long-term strategy. But we can look at their recent performance and the information they present to get a better idea. Interestingly, the BUZZ ETF would have underperformed the market, being the S&P 500, from about 2016 to 2018. To me, this means that maybe social media sentiment isn't effective when used on a monthly basis. However, the index would have produced very strong returns over the past few years, especially within the last year, outperforming the S&P 500 140% to about 70%. So how can we explain its recent performance? Well, as you might expect, social media activity exploded at the start of the pandemic. As you can see by this chart, an increase in the number of messages provided more data for the BUZZ index to analyze. The BUZZ index began to perform far better during this period, which could be linked to increased social media activity. Another study listed in the white paper mentions that the accuracy of crowdsourced information will increase with a greater diversity of data sources. With the boom in online activity and collaboration we've seen in response to the pandemic, it's possible that the BUZZ ETF now has access to enough information to make better decisions than it did a few years ago. Their argument is with more information to pull from, they'll be able to better identify high conviction stocks and outperform the market. But if this is in fact the reason that the index has just started producing these kinds of returns, it's possible that the long-term success of this fund might depend on the continued use of social media and the rising activity of retail investors that we're seeing today. So ultimately, I find it tough to say for sure that this fund will be successful long-term. I think if the increase in social media activity is in fact the reason for its recent success, then it will probably continue to be successful for the next few months, at least until the pandemic is over and social media use starts to decline or people lose interest. Additionally, I want to highlight a few other things that you might want to consider before investing in the BUZZ ETF. For starters, like we said, they rebalance and reconstitute the fund monthly. A lot of the studies they provided showed that social media sentiment is an effective indicator for short-term periods, but might not work for much longer than a few days. Considering the fund may take as long as a month to add a new holding to the portfolio, I'd be worried that they're adding a stock too late and therefore missing out on returns that they could have secured by moving a little faster. This is one of the rare cases where I think active management could be beneficial, because they would be able to make those trades at any time to secure the highest possible returns. Second, this strategy will result in a fairly high portfolio turnover. Last year, the index would have held 176 different stocks. That's a lot of stocks that are cycling through the portfolio. Obviously, this is the nature of the index, and their intention is to hold the most popular stocks at a given time, but this does come at a cost. First, this portfolio turnover may create capital gains taxes that are passed on to its investors. Second, it increases the expense costs of the fund, which explains the next thing you'll want to consider about the BUZZ ETF. And that's the fact that the BUZZ ETF has a 0.75% expense ratio. That's pretty high, especially for a passively managed fund, but again, it's likely driven by the high portfolio turnover. Between the expense ratio and the portfolio turnover, the BUZZ ETF could be a fairly expensive investment to hold, and will need to continue to generate significant returns in order to make up for these costs. I don't feel strongly enough that the BUZZ ETF will continue to outperform other strategies over the long term. The biggest downfall to me is that they only change their holdings once a month, which I think limits their ability to capitalize on all of the social media data they're collecting. However, I'm still really fascinated by this strategy, and I'm excited to follow the fund's performance to see how it does moving forward. Plus, I think it could be the first of many ETFs following this kind of social media sentiment strategy. For example, we're due to get a FOMO ETF soon, which will also target some of the hottest investments on the market. In this case, they plan to rebalance weekly, which would be costly but could be exciting for returns. So I'll be on the lookout for these and more funds like them. If you guys have any thoughts on BUZZ, the FOMO ETF, or any similar strategies, let me know in the comments. Thanks for watching, and I'll see you next time.